Good afternoon, everyone, and welcome to the latest webinar from the section of Civil Rights and Social Justice, with co-sponsorship by the section of State and Local Government Law. During the 2017-18 bar year, our goal is to rapidly respond to government action that may impact civil liberties and civil rights by offering free webinars, commentary, podcasts, social media, and other information from subject matter experts. We encourage you to check out our section website, www.americanbar.org/CRSJ, our Facebook page, and our Twitter handle @ABA_CRSJ for more news and information and replays of our great programming. They're all free. If you like our work, we invite you to become a member of the section and collaborate with us on projects you want to develop and offer to our members and the general public. During today's program, we invite our attendees to ask questions of our panelists. So in the right-hand control panel for this program, you will see a questions drop-down box. Please ask your questions there, and we will be reviewing in order to answer them during our final Q&A portion of the program. We also draw your attention to the handouts, where you will have access to the PowerPoint presentations from our panelists. Today's program, entitled New Federal Tax Cuts and Jobs Act, Increasing U.S. Income and Wealth Inequality, is co-sponsored by the section of Taxation, the section of State and Local Government Law, and the Civil Rights and Social Justice section. Our moderator today is Marilyn Harbour, who works at the Tax and Finance section of the Oregon Department of Justice. And I turn it over to you, Marilyn.
Thank you, Paula. Our program today will be in 3 segments. We'll begin with the macro effects of the Tax Cuts and Jobs Act, with an overview of the economic inequalities and the state's response to those issues. And the presenter of that portion is Dean Baker, who, because of technical difficulties, will only be a voice on this presentation. But Dean is the senior economist at the Center for Economic and Policy Research, which he co-founded in 1999. His areas of research include housing and macroeconomics, intellectual property, social security, Medicare, and European labor markets. He's authored several books, including Rigged: How Globalization and the Rules of the Modern Economy Were Structured to Make the Rich Richer, and Getting Back to Full Employment, A Better Bargain for Working People. He received his BA from Swarthmore College and his PhD in economics from the University of Michigan. Dean's name pops up frequently in TV presentations and books. Most recently, Noam Chomsky quoted Dean in his book, Who Rules the World? The second segment of the program focuses on the distributional impact of the Tax Cuts and Jobs Act, how it plays out across income groups, and will include a focus on the new deduction for pass-through business income and a little bit of the overview of the Tax Cut Jobs Act provisions that affect low-income persons. Second panelist is Alexandra Thornton, also known as Alex Thornton. She's Senior Director of the Tax Policy at the Center for American Progress. Alex has expertise in tax and fiscal policy, tax reform, tax administration, individual and corporate income taxation, environment, and energy taxes. Prior to joining the Center for American Progress, Alex was the Executive Vice President for Policy Planning and Business Affairs at the Jane Goodall Institute, where she functioned as General Counsel and advised on international conservation issues. Prior to that, she served as the in effect, tax counsel for a senator who served on the Senate Finance Committee. And during that 10-year period, she successfully shepherded the senator's legislative initiatives through 9 major tax and budget bills, and also provided counsel on trade, banking, and securities issues. Alex has written and spoken extensively on these issues. 2 of her recent publications that may have a bearing on this program today include Many Working and Middle-Class Americans Would See a Tax Increase Under the House GOP Tax Plan, and Giving Away Corporate Tax Cuts is Not How to Make the United States More Competitive. The third segment of the program will focus on the impacts on low-income persons. And Professor Francine Lippman will provide us with detailed information regarding those impacts, including, for example, withholding, confusion, the repeal of the personal and dependency exemptions, and the increased child tax credit, and how that benefits higher income families more than lower income families. Professor Lippman is, get my right notes here, the William S. Boyd Professor of Law at the University of Nevada in Las Vegas. She is an accountant, a lawyer, teacher, and scholar. After working as a CPA in an international accounting firm and as the chief financial officer for a chain of retail jewelry stores, she turned to the law, where she served as the editor-in-chief of the UC Davis Law Review, and was recognized as an outstanding law student and member of the Order of the Coif. She attended NYU's graduate tax law program, where she was a tax law review scholar, and then practiced law with Melviny and Myers, LLP. Professor Lippman has written extensively. She has many publications, as you can see from the biographical information. It is linked on the website for this presentation, which I can't go into for all 3 of the panelists today. They've all written a lot of things, but I noticed one of Professor Lippman's recent articles is entitled Anti-Poverty Measures Exposed, published in the Florida Tax Review. This 82-page treatise is well worth looking at if you're interested in poverty issues, because she addresses how the measurement of poverty has affected the successes and failures of poverty programs. So with that, we will proceed, and Dean Baker is our first speaker. So I will turn it over to you, Dean.
Okay, thanks, Marilyn. I apologize for hiding. I'm not really trying to hide from everyone. It's the special counsel I'm hiding from. But anyhow, I don't know exactly. We had this working before, but trust me, I'm actually here. So what I want to do is talk about, well, let's see if I can get my PowerPoint working. There we go. 4 aspects of the Tax Cut and Jobs Act. And I'm focusing, I'm a macroeconomist, so I talk about macroeconomic issues. Talk about its impact on the economy as a whole. I'm going to focus first on the corporate tax break. This really was the centerpiece. The Republicans, the Trump administration said that, so I'm not casting aspersions on them. It really was the centerpiece of their tax cuts. I will talk about that at some length. Then the pass-through provisions. I'm just going to talk about these as the economic efficiency, not the distributional issues. I believe Alex will talk about that. Third is limiting the state and local income tax deduction. I think that's a very, very important provision, and it's been quite controversial in states around the country because I think it is directed very much at the more liberal, more progressive, whatever you want to call them, heavy spending, big spenders, whatever you want to say. It's directed at them. And the last point, that they created, in essence, a territorial tax. It's a little more complicated than that, but the point here is that for the most part, companies will not be taxed on their foreign profits. And I think that's potentially a fairly big deal. Probably has not gotten as much attention as it deserves. Okay, so starting with the cut in the corporate tax rate, this is estimated, the Congressional Budget Office puts the cost over 10 years at roughly $750 billion. They lowered the tax rate from 35% to 21%. The argument, well, two arguments they gave. I mean, first off, they were arguing that we had a very high tax rate at 35% compared to other countries, other wealthy countries. That was true, but somewhat deceptive. So 35% was a higher nominal tax rate than what you saw in most other countries. But if you looked at effective tax rates, what was the share of profits companies were paying in taxes? We were right about the middle of the OECD. So if you compare us to Germany, France, we're right in the middle of the pack. A little higher some years, a little lower, but that we were not out of line that way. But there is an argument, and this is their second point, that if you lower the tax rate, you'll give companies more incentive to invest. And, you know, the argument, if you look at what Kevin Hassett, the head of the Council of Economic Advisors, said, this would amount to over 4,000, perhaps as much as 6,000 or 8,000 a year in additional income for a middle-income family. Okay, so we put this in place, and immediately afterwards, there's this big effort to say, okay, who's getting it? And there were a number of cases where companies announced bonuses. On the other hand, many companies, of course, have announced or are doing share buybacks. The bonuses, I'll just say 2 points about it. One is that they were in almost all cases a relatively small share of the tax cuts. I actually did the arithmetic on this with a number of the major companies, Verizon, AT&T. For the most part, when you look at that, the bonuses were around 10% of the tax cuts. I'd also point out that these are one-time bonuses, whereas the tax cuts they'll get year after year after year. So you're looking at bonuses that maybe they'll repeat them next year, we don't know, but the whole point of a bonus is the one-time grant. And those were about 10% in most cases. Some companies were more generous, so I do want to say that. Other companies, of course, actually did give pay increases. The other point, and this was not well covered, a lot of companies announced bonuses right at the end of 2017. They were in effect paid lots of money to do that because under the tax law, if you announce a bonus in 2017, you could deduct it in 2017. So what that means is you're deducting it at a 35% rate rather than if you deduct it announced in 2018, where you can only deduct it at a 21% marginal rate. So in effect, we're paying companies a lot of money to announce their bonuses in 2017, which isn't surprising that many did. Okay, so that was, you know, the original story. As I say, if you look at a breakdown, the vast majority of the money does look like it's going to shareholders, not to workers. But that really wasn't the argument. The argument was that it would spur investment. So again, looking at Kevin Hassett, the head of the Council of Economic Advisors, he was saying that there'll be a big increase in investment that will increase productivity, and that will lead to benefits to workers that are several times the size of the tax cuts. So the point here is looking at the original distribution. Do they pay it out in dividends or share buybacks? Did they give it in wages? That's really the less important issue. The important point was that they were claiming that this would lead to a big increase in investment. Now, I'm very skeptical of that, as were the vast majority of economists. For the most part, evidence suggests that tax cuts, that investment is not particularly responsive to the tax rate. So there's a lot of research on this topic. It's a well-researched topic, and at least the vast majority of research I'm familiar with indicates that investment does not respond in a big way to tax rates. And we actually did try this. I was amazed in the lead up to the tax cut that this wasn't more widely noted. 86, I'm not that old. I mean, 86 was in many of our lifetimes. We did have a big cut in the corporate tax rate. It was 46% prior to the tax reform of 86. We knocked it down to 35%. That's basically as large as the current tax cut. And there was no uptick in investment. Investment actually fell relative to the size of the economy in 87 and 88. I'm not going to say it was because of the tax cut, but needless to say, if there'd been some big surge in investment, we wouldn't be seeing it fall as a share of GDP. So long and short, I don't think we had much reason to believe that this tax cut would lead to a big spur in investment as the Republicans, as President Trump had promised. And we do have some evidence on this, and it's surprising to me, again, this is getting a little press in the last few days. I think I've prodded some reporters. I should take a little credit for this myself. But in any case, we have seen, we have evidence on investment plans. So certainly, you know, the Republicans, the Trump administration is right to say, well, you can't just invest overnight. But if we take seriously that investment is very responsive to tax rates, the outlines of this tax cut were well known by September. You know, they were put on the table. They were obviously subject to debate and some revision, but the basic story that there was going to be a large cut in the corporate tax rate, that was well known by early September. If firms are really very responsive to investment, it's hard to believe that, say, a big company like Verizon, General Electric, they don't have someone saying, you know, hey, what are we going to do? This thing might go through. What are we going to do if the tax rate falls to 20% or 21%? And if that were the case, it does go through in Congress, the Senate passes it in the middle of December. It's a little hard to believe that they wouldn't already be making orders. So we have data from the Commerce Department. In fact, the latest data just came out this morning on orders for capital goods. And those are going nowhere. They're up a little bit some months. They were down in the most recent month. There's no evidence whatsoever in the data for the months that we have, January, February, and March, that there's any sort of uptick in investment, orders for investment, I should say, induced by the tax cut. There's also, I should point out, any number of business surveys. The National Federation of Independent Businesses has surveyed its members for close to 40 years. No noticeable uptick there. The Federal Reserve Board, the regional Federal Reserve banks, the Philly, New York, Atlanta, no evidence of any uptick there. And again, they're asking about plans. So it's not, I'm not saying, oh, you should have had a new factory up and running. Are you planning that? There's no evidence of that. So long and short, I think it's fair to say that we're not going to see big wage increases as a result of this tax cut, a big spur of investment. It will be a dividend to shareholders. Okay, this is just one, I don't have the most recent data point here, but this is giving you the capital good orders, excluding aircraft. Aircraft are very jumpy, so I pull those out. That's standard. I mean, they pull it out, so I didn't even have to do that for you. So no evidence of any noticeable uptick there. Orders had been rising through 2017. That was primarily because of the energy sector. Oil prices rose. That led to increased drilling, and that was associated with new orders. If you pull that out, nothing much going on there. Okay, the second point, pass-through income. This, to my mind, is a remarkable story because across the board among economists, there's a view you want to treat all income the same way. And in fact, that was one of the things in the '86 tax reform. You had wide support, liberals, conservatives, Republicans, Democrats. It's bipartisan. Big part of that story was you treated income the same regardless of where it came from. They actually had capital gains taxed as ordinary income. There's some problems with that. But the idea is you don't want people playing games. This goes 180 degrees the opposite direction. It says, okay, if you get income from a pass-through corporation, we give you 20% off the top. So you're all lawyers here. Most of you, I assume, are lawyers. What this means is if you could figure out how to have your law practice as a pass-through corporation, you can get 20% off the top. Now, in principle, you're not supposed to be able to do that as a lawyer. But what you could do, I don't want to be giving you tax schemes, but you set up a law office. You have the real estate where you pay rent to the real estate, which you happen to own, and you get 20% off on the money you get from the rent from the property you own. There's a lot of gaming like that you could do, and needless to say, people are doing it. There's any number of accounting firms saying, here's how we could set you up as a pass-through corporation. That is not the thing you want to do. Just again, some of the coverage on this, I don't know how many times I saw, oh, they want to treat pass-through corporations like other corporations. No, they don't want to treat pass-through corporations like other corporations. Pass-through corporations don't pay taxes. So that was just nonsense. It was utter nonsense. We're talking about income from pass-through corporations, not with the tax the corporation itself pays. So this is something, again, Alex, I gather, will go into some of the equity implications, but it's just very, very difficult to see why you would want to give special treatment to income from pass-through corporations. This goes 180 degrees at odds with what economists typically think of as tax reform. And I'll just mention, I had a reporter send me and two other economists a note, what do we think was the most pernicious aspect of the tax thing? And we all independently, myself and the other two economists, said the pass-through tax breaks, because you could kind of justify most of the other things, and you could argue good or bad, but you could make some justification. We couldn't think of a justification for that. Okay, limiting the state and local income tax deduction to $10,000. This is a shot at states like New York, California, Illinois, where I'm from. These are states that have relatively generous social welfare states, they spend more in education, tend to have higher TANF, higher, say, housing subsidies. They do try to support the, not that many of you, I'm sure, live in these states and you tell me how ungenerous their Medicaid is or their TANF. But you compare, say, New York to Louisiana. New York, the average TANF benefit is somewhere around $700. I have the number in front of me, but in that neighborhood, $700 a month. In Louisiana, it's about $180. So there's very big differences. And if you provide more generous benefits, it costs more money, which means you have higher taxes. And this, I've argued with people about this because obviously the people paying the higher taxes, people benefit from the self-deduction, are higher income people, almost by definition. But the point, and the Republicans were saying this when they were putting this in, they want to make it more difficult for California, for New York to pay high TANF benefits, to have a generous Medicaid program. They said that. And there's no doubt in my mind that it will have that effect. It doesn't mean immediately that, people lose the deductions and then they, run to their state representative and say, hey, you got to lower my taxes, or in some cases move. That won't happen immediately. But over time, the fact that people can't deduct most of their state and local taxes is going to have an impact on these states' ability to raise revenue. I don't think there's any doubt about that. So this was an intention of the plan. And also, I'll just add one more thing on this. In a context where, at least in the immediate future, you're very unlikely to see major social initiatives coming out of Washington. I mean, after 2021, if there's someone else in the White House, who knows? But, 2018, 2019, 2020, very hard to see a major expansion of healthcare benefits, of education benefits. If you're going to see those things, it's going to come from the states. So again, this is a reason why I think it's very important that, states have the ability to tax what's necessary to raise the revenue to provide social services, both their current levels and ideally to expand it. As many states, New York, for example, is trying to give free college to many of its residents. So these are good things in my view. It's difficult for them to do that if they don't have the deduction. And just to put it as simple as possible, under the old tax code, if you're paying another $100 in taxes, basically the federal government was picking up $40 of that, so you were only paying $60. Now you're paying the full $100, so that's going to discourage that. There are workarounds. I'm going to take some pride in this because New York passed in their budget last month, or I guess 2 months ago now. They included one of the ones that I think probably is the clearest, cleanest employer-side payroll tax, that they're replacing a portion of their income tax with an employer-side payroll tax, just to make it as simple as possible. Suppose someone has an income of $200,000, employer-side payroll tax, say 5%. Instead of paying $10,000 to the state in income taxes, your employer pays that as a payroll tax. What economists would expect is that would lower your pay to $190,000, lowered by $10,000. Your employer is going to pass it on in lower wages. But the point is, you only pay federal income tax on the $190,000, not on your full $200,000. In effect, it preserves the deductibility of that $10,000. And what's neat about that is it does that whether or not you itemize. So that's a good way to offset this. It doesn't fully offset it. It doesn't offset it for everyone, but it offsets much of this limitation on the state and local income tax deduction. Okay, the last issue, territorial tax for multinationals. This, I think, is a big deal, bigger deal than I think people have recognized in general. So under the old tax code, foreign companies could defer their foreign profits for as long as they kept the money abroad. And this got to be a real mess. We had, I think it was $2 trillion that in profits that companies had listed as being abroad. And that this is really just an accounting maneuver. In many cases, the money was held in accounts in the United States, but it was just registered to a foreign subsidiary. So this is purely an accounting issue. It allowed them to delay taxes, and always what they expected was that there would be a tax holiday. So the last time we did this was in 2005, and we said that rather than having your profits taxed at the ordinary 35% rate, bring them back in 2005, and they'll just be taxed at a 5% rate. And that's what companies did, and supposed to go to investment. It didn't. There was no noticeable uptick in investment. They just paid out to shareholders. Well, that was a silly system. I think anyone could agree on that. They said, okay, under this new system, if you earned it in Ireland, if you earned it in France, whatever, you don't have to pay any tax on it. There is a separate tax, a minimum tax rate on intellectual property related income. I believe it's 8%. I won't swear to that. It's somewhere close to 8%. So that's at least something. And that is important because the big tax gaming issue here is you have companies like Apple and Google that claim that a very high share of their profits were actually made by their Irish subsidiary. Ireland is a tax rate of 10%. So if you'd rather pay a lower tax rate, you just say that your Irish subsidiary was responsible for all your profits. Okay, well, that's what they were doing when it was simply deferring the tax. They have even more incentive to do that now when it's not just deferring it. It literally, they literally will never have to pay the tax. So if they could say the money was earned in Ireland, the money was earned in France or Bahamas, whatever it might be, they never have to pay U.S. tax on it. Again, there is the exception that if it's tax rate, if it's intellectual property related income, they still have to pay 8% U.S. tax. Now, my last point here is that gaming will be widespread. Again, when you're constructing a tax code, you want it to be as simple as possible. You want it's, to my view, worth giving up revenue for simplicity. You want to make as few opportunities as possible for gaming, as few incentives as possible for gaming. Going to a territorial tax, I think, hugely increases the opportunities for gaming. So my expectation is we will see many more companies, probably not actually moving their operations, moving their jobs overseas. People play that up. I don't think very often we see a company say move to Ireland in terms of moving a large amount of its operations actually to Ireland. They're simply doing accounting tricks to have their profits appear in Ireland. And I think we will see more of that simply because the incentives are much greater when you're allowed to avoid the tax altogether rather than simply deferring it as had been done under the old system. So just to sum up, again, Alex will go into the distributional aspects more, but I think it's pretty clear the corporate tax cut, the pass-through, these are tax breaks that will benefit higher income people. These are not going to go to low middle income people at all. The growth effect, they promised a big increase in growth. I think that's implausible on its face. It's just, could there be a trivial increase? Anything could happen. But are we going to see 3% growth as they were promising? I had big arguments with friends. We could see 3% growth because of anything in the world, but will we see 3% growth because of their tax cut? No. And in some ways, the worst part, it's going to be a big boon to the tax shelter industry, and that's not what you want. We want to see productive businesses. We don't want to see accounting firms expanding so they can come up with new schemes, and I think that's going to be the major outcome in terms of the economy. So I'll stop with that. Thank you.
Thank you, Dean. Alex, do you have any questions for Dean? Or
sure. I just wanted to point out, a lot of people talk about even the small amount of wage increases that there have been. They want to take credit for that from the tax bill. But isn't that really a function of the tight labor market that we've seen a little bit of wage growth? And also, when we look at the current expansion that we're in, which has been so far almost a 9-year economic expansion, isn't that really a result of the worldwide expansion and sort of the U.S. expansion since the Great Recession as opposed to any tax cuts?
Oh, sure. I mean, the wage growth, and I've been writing about this for a long time. I've been very happy that the unemployment rate's been falling, and this, President Trump wants to take credit for a 4% or 4.1% unemployment rate. Well, the unemployment rate had been falling. It's continued to fall. And to my view, sir, the best way to think about the economy is think of it like an oil tanker, super tanker. It keeps going and going and going unless it hits something. And basically, we've been in a recovery since summer 2009. It picked up some speed in terms of job growth the last couple of years of the Obama administration. We were creating over 200,000 jobs a month. It's pretty much continued at the economy's continued to grow pretty much the same pace 2017, first quarter 2018 as it had been the last year of the Obama administration. Job growth is actually a little slower. I wouldn't make a big point of that, but basically we're continuing on the prior path. And in terms of wage growth, the labor market is getting tighter. It had been getting tighter. And you had things like, Walmart, and I think it was Target. One of the other big retailers announced that they were going to have a minimum wage of $11 for all their workers, $11 an hour. It's a good thing. But they were doing that because they see a tighter labor market, and we were getting announcements along those lines last summer before anyone knew about the tax cut. So you're very hard pressed to find any evidence that this tax cut has improved on the economy's path. So, I mean, I think it's fair to say it hasn't hurt. You know, I couldn't give you any evidence it's hurt. But, you know, if you just go, okay, what was the economy doing in 2015, 16, 17? Is there some reason to think it's now doing better because of the tax cut? You're really hard pressed to say that.
The other thing I was going to ask you is, isn't this really, when we have an economic expansion and we're doing well, wouldn't it have been better to make a different use of the funds rather than tax cuts for the wealthy and for corporations? Isn't it time to repair the roof when you are in an economic expansion to get ready for the next recession, which will inevitably come? Because it seems like the people that get hurt the most during a recession are the people at the lower end of the income spectrum.
Well, we have a need for more spending in a wide variety of areas. Certainly infrastructure is one of them, and for whatever it's worth, I mean, President Trump ran on a big infrastructure program. It was, you know, when he actually put something on the table, insofar as he put an outline on the table, was kind of convoluted. It was mostly, we're going to have private business come in. Well, private business could always, you know, if they want to spend on infrastructure. It was not a well worked out plan, I'll just say that. But yes, we should be spending on infrastructure, spending on education. We have a lot of needs that weren't met because of the recession, and you know, really, it was the Republicans insisted on austerity. I mean, the Obama administration wanted to spend more money on education, something like universal pre-K, which does not cost a lot of money, and very good research showing that it pays off. And you know, in other words, the kids who benefit from that will see improvements in their educational outcomes, their career earnings. So there are a lot of areas where we desperately could use the money. Giving more money to the richest people in the country, hard to see how that should have been a high priority for anyone.
Right. Alex, are you ready to
Sure.
go through your presentation now?
Okay. I need to click on the X. There we go. Is my screen showing up? Oh, here we go. Show your screen.
See the slides.
Got it. Is that showing me? No. Click to show my screen. Now is it showing?
I see you, but no slides.
I'm having a little trouble figuring out. Oh, I see. How about that? Can everyone hear?
Not yet.
You can't see my screen?
I can see you, but no slides.
It
And
seemed
to the audience out there, believe it or not, we did practice this.
I'm clicking the orange arrow.
There you go.
There you go.
All right.
You got it.
Good. Okay, well, I'm going to be talking about the distributional and fiscal impacts of the 2017 tax law. And I wanted to say that it gets confusing when we talk about the impacts of this tax law, because on the one hand, there are these economic effects that Dean was referring to, where the expectation was that if they gave large tax cuts at the top, that the wealthy and big businesses would invest more, and eventually that would lead to economic growth and jobs for many people. But as Dean has just said, we aren't seeing any signs of that really yet. But the other way that the tax bill was supposed to benefit working and middle income people was through direct tax cuts. And I wanted to focus on those right now. This is a slide showing exactly what happened from the tax bill. The way that economists prefer to look at the impact of a tax bill is to look at the percent change in after-tax income from the measure. And what this shows is that the wealthy and the wealthy overwhelmingly benefit. It's these three columns here. This starts at 200K to 500K and up. Whoops. The change, showing the change in after-tax income is the best way to look at it because it shows the proportionate change in a household standard of living. And this data is from the Nonpartisan Tax Policy Center, which also shows it that way. And I would point out that while this is for the first year of the tax bill, 2018, this distribution stays roughly the same for the 8 years that the temporary individual income tax provisions are in effect. Now, this chart shows the actual dollar amount of the average tax cut in each of these income categories. And so you can see it's fairly stark here. The average annual tax cut for 2018 is very small for all of these income groups. And it's really only when you get up to the higher income groups that you see these sizable tax cuts. And in fact, you know, those making more than $1 million will get an average tax cut of $70,000. Many of them, especially in the top 0.1% of income earners, will actually make get much larger tax cuts. Meanwhile, the tax cuts decrease sharply as you go down the income scale, and families, for example, making 75 to 100K will see an average tax cut of $1,310, spread out, of course, over the year. And then the tax cuts for lower income families are even smaller. And what I did was I put the lower income categories here so you can see what the average tax cut is. 50 to 75,000, the average tax cut is $870. 30 to 40, it's $360. That's not, it's just $360. And less than $10,000 of income, it's $10 for the year. That's less than $1 per month. So you can see that these tax cuts are pretty minimal. And when you spread them out over the year, if people adjust their withholding, it's really not going to reflect much at all in their paychecks because paycheck amounts are affected by a lot of other things as well. It's really no wonder when you look at this that the majority of Americans aren't really seeing any difference in their paychecks and that they're not terribly excited about the new tax law. Now, one of the reasons the reason why the wealthy are gaining so much is that there were many provisions, as Dean referred to, in this tax bill that benefit the wealthy. Some of those provisions, the major ones, are the cut in the top tax rate, individual tax rate, from 39.6% to 37%, the pass-through business income deduction that Dean referred to, and I'll have more on the distributional impact of that in a moment. The increase in the amount of income that's exempt from the alternative minimum tax, and then a doubling of the exemption from the estate tax up to $22.4 million per couple. The one provision that benefits the wealthy a lot that is not temporary, it's permanent, is, as Dean referred to, the corporate income tax rate reduction. I wanted to talk about that a little bit and focus on it so that people understand that the corporate income tax cut in the rate is actually very much skewed to the wealthy. And Dean also mentioned that this chart shows it in a little more detail. Essentially, what you're looking at here is this chart is from the data from the Tax Policy Center, and it shows the corporate tax cut distributed across income quintiles. So that's 20%. But then this last 20% is split out here. And you can see that the top 5%, this column, actually gets almost 50% of the benefit of a corporate tax rate cut. Meanwhile, if you take the whole top 20%, they get almost 70% of the corporate tax cut. So the owners or shareholders of a corporation are the direct beneficiaries of a corporate tax cut. You can, simply speaking, lower taxes mean higher after-tax profits for corporations, and the owners and shareholders are the ones who immediately benefit from that in the form of, you know, higher value for the shares they hold and so forth. That's a separate issue from the long-run investment of the corporation and whether any of those benefits trickle down to workers in the long run. So people sometimes ask the question, well, what about all the stock that people own in their retirement savings accounts? Surely there are a lot of those, and a corporate tax cut would benefit those people. And the answer is yes, they do, but you have to keep in mind that not as many people have retirement savings accounts as one might think. I don't have the data in front of me, but it's a very small percentage. And in addition to that, they often don't hold a lot of stock, whereas people at the top of the income scale own a huge amount of corporate stock, not just in retirement savings account, but in other investment accounts as well. Now, and I did want to also point out, I didn't want to forget to mention that about 25% of corporate stock is held by foreigners. I think Dean referred to that as well. So a good portion of this tax cut is actually going to benefit people outside of the US, which I don't think was the original intent of those, at least the claim of those who were pushing for this tax law. Now, the fact that the corporate tax cut is permanent explains why the wealthy continue to see large tax cuts in the later years. It's the main provision that's permanent, other than the change in the index, the inflation index that's used to adjust the different brackets and other parts of the tax code. That's the other piece that is made permanent, and it actually is a slower inflationary measure, which means that over time, people will, especially at the lower end, will fall into higher and higher tax brackets. So after the individual income tax provisions expire as of January 1, 2026, people in the lower brackets will begin experiencing higher and higher taxes. This will be a gradual thing, but this is showing 2027 based on data from the Tax Policy Center again, and it's showing the percent change in after-tax income. And as you can see, it's negative for people making $75,000 or less. It's sort of no change for little middle income groups. And when you get to the higher income groups, 200,000 and above, and especially for those making more than $1 million, of course, their change in after-tax income continues to go up as they benefit from the corporate tax cut. So actually, by 2027, 83% of households will experience a lower after-tax income as a result of the increased taxes under the new law from the chain CPI. So Dean, of course, explained how the new law's large tax cuts was a questionable strategy for economic reasons. They also don't make sense when you look at other factors, like the fact that the US's overall tax burden is incredibly low relative to most other countries. So this is an OECD chart showing the tax burden. This includes all taxes. And you can see that the middle orange bar is the average in the OECD. And here's the United States tax burden per capita. There are only 4 countries below the US. So this was not a particularly good time to be giving a tax cut, especially when you also look at the income inequality that exists today. This chart shows pre-tax income. So this is before tax incomes of the top 1%, which is the red line, and the bottom 50%, the blue line, going back to 1962. And then here, looked at another way, this is the share of total national income in the US of the top 1% during that time period going up. and the bottom 50%, of course, going down. So you may be thinking, well, but the government also gives tax dollars back to people. But actually, those government transfers and so forth don't actually alter income inequality very much. And this graph from the Congressional Budget Office is helpful in visualizing that. It shows the impact of government transfers and taxes by income group back to 1979 by quintiles, income quintiles. And you can see here that the top 1% has 228 times the income that it did back in 1979. So this is what we're seeing. And the important thing to know is that wealth inequality, income inequality is, an annual type of thing, but wealth inequality, the cumulative wealth that people hold, is actually far greater than income inequality. And of course, income inequality contributes to wealth inequality as it enables the wealthy to accumulate that much more every year. But the wealth inequality is reaching near historic levels as a percentage of GDP. So the 161,000 families in the top 0.1% now own as much wealth as the 145 million families in the bottom 90%. That's a pretty staggering statistic. And every year that we allow these huge tax cuts for the wealthy to remain in place, the wealthy will be getting that much wealthier. So it's been proposed to extend the provisions, the individual tax provisions, as a way of potentially addressing this issue of inequality in this tax bill. But I wanted to make a point that extending the individual temporary provisions will not accomplish that. This chart from the Institute for Taxation and Economic Policy breaks down that extension by income quintiles. And as you can see, you should focus on the gray columns here. The benefits largely go to those at the top. And clearly the law needs to be fixed, but Congress could do better than this if it wants to improve fairness in our tax system. And a clean extension with nothing else would waste money on the top while giving very little to the middle and the bottom. So I wanted to focus on among the temporary provisions that would be extended, and among the temporary provisions in the tax bill. Most of them you can see how they would benefit high incomes if they were extended, like the cut in the top rate. But the pass-through deduction is a little bit less clear, and I want to get into a little bit more detail on that and make a few different points from what Dean said, because this provision is a really important provision to focus on. First, for those of you who don't know, a pass-through business is basically a business that doesn't pay the corporate income tax. All of the business's income is passed down ratably to the owners or shareholders or partners who include that portion of the business's income in their own personal income tax returns to be taxed there. So sole proprietorships, partnerships, S corporations, LLCs are all taxed this way, except for a small number that elect to be taxed at the entity level. So if you're a person who receives pass-through income, pass-through business income of some kind, under certain circumstances, you'll be able to deduct 20% of that income from your taxable income. So it's going to lower your taxable income, and the fancy math folks have figured out that this translates into a top effective tax rate on pass-through business income of 29.6%. This is income that previously the top rate was 39.6% for this. So it's basically a 10% rate cut. Now, who can use it is totally illogical, confusing. It really hasn't been figured out yet. It's hugely subject to gaming. But basically, essentially, singles making $157,000 and married filing jointly with $350,000 of income who have qualified pass-through business income, and that's a big issue there, then they would be able to take this deduction. Above that amount, it's gradually phased out, and businesses, only certain businesses are allowed to take it. Supposedly not service businesses, but real estate businesses, yes. Supposedly not financial services businesses, and not businesses that are based on the reputation of an owner. It's very illogical. So assuming you're not excluded, then you have to meet another test where you can deduct, the deductible amount can't exceed 50% of your W-2 employee wages, or if it's greater than that, 25% of your W-2 employee wages plus 2.5% of the unadjusted basis of qualified property. This was a provision that was put in basically for real estate pass-through businesses. Now, the whole pass-through deduction expires on January 1, 2026 under this law. But I think, again, I wanted to make the key point that this mainly benefits the wealthy. While over 95% of partnerships and S corporations are truly small in size, most of the income from S corporations and partnerships in the US is made by the few that are not small. Wall Street firms, big lobbying firms. And while most sole proprietorships are truly small, most also already fall in a lower tax bracket. So prior, up until now, under the pre-2018 law, 86% of tax filers with pass-through business income actually were already in the 25% bracket or lower. So these facts explain why the benefit is so small for small businesses. And in 2024, before, let's see if I've gotten that, okay. Oh, so this chart actually shows the benefit in 2018 and in 2024, which is before it expires. And you can see it gets larger and larger as you get close to the year when it expires. And the cost of this provision to the Treasury over the 10-year period of the bill is $415 billion. And something that's of concern perhaps to people who are watching this web presentation is that there may be some really confusing issues for low-income folks, because some of them are in types of jobs where they're encouraged to be independent contractors and not getting all the benefits of being an employee. There's a concern here that if they try to file for this deduction or to claim this deduction on their tax return, and it's subsequently determined that they're an employee, will they be required to recapture some of this tax, or can the IRS recapture some of that tax break that they had? It's also just terribly confusing for them, and it's not clear that even if they could legitimately take it, that they would know how to do it, because of course they can't afford the high-paid advisors that wealthier folks do. So the last thing I wanted to look at was just to show you the effects on the budget of this tax bill. And this chart combines the tax bill as written, which is the darker red, with the cost to the Treasury, to the federal government, if we extended the temporary provisions, that's in the brighter red. And I wanted to also note that, you know, Dean and I both have been saying how there's a lot of potential gaming in this bill. And interestingly, in its most recent report that just came out, I believe it was last week, the Congressional Budget Office actually increased its projection for the losses over the decade from this tax bill to $1.9 billion instead of 1.45. So who knows when, you know, sophisticated taxpayers, wealthy taxpayers figure out more ways to get around this, what it will cost. And then the last thing, in order to segue into Francine's presentation, I wanted to just give just this little overview of the major provisions affecting working and middle income families, and just point out that the personal exemptions that are suspended, the standard deduction that's increased but doesn't make up for the personal exemption lost for many families, the child tax credit changes, which Francine will go through in greater detail, and the rates, the somewhat lower rates, those all expire at January 1, 2026. but the chain CPI inflation indexation is permanent, as well as the repeal of the ACA individual mandate. And that's all I had.
Thank you, Alex. All right, Francine, are you ready to proceed? Professor Lippman. I cannot hear you.
Hello, I'm about to get my PowerPoint up.
Well, now we can hear you, and the PowerPoint appears to be trying to get up. There we go.
Excellent. Well, thank you so much. I want to give a shout out to Paula for herding the cats and getting this presentation webinar and all of our smiling faces up on the screen, as well as our audio. Thank you very much, Paula Shapiro. Without your tenacity and attention to detail, this would not happen. I also want to thank Marilyn Harbor for organizing this. While she is a clear leader in the ABA section, including the tax section, social justice and civil rights section, she also has a full-time job. So she is doing this because it has to be done. And that is something I want to say to all of us here. These issues are more than critical. They are every single day impacting our economy. And most importantly, I'm going to get into the weeds here and talk about working families that are truly just trying to make ends meet. We are, the three of us, the four of us, an excellent partnership here because Dean is the economist and takes us from 35,000 feet looking at the entire globe and talking to us about how this U.S. tax provision impacts the whole world. And then Alex talks about the distribution between high income, middle income, and lower income families, and looks at how the permanence or impermanence of these provisions are going to affect us. And I am going to take you, like an ethnographer, into the living rooms of these families. And so let's talk about how this works, or perhaps how it's not working for working families. As Alex has already said, there is an enormous amount of complexity in this Tax Act, and I think the most laughable thing about it is that it could fit on a postcard. It is enormously complex for every aspect of this provision, but the individual tax provisions are especially complicated because they are temporary. And so what does that mean? Well, most of the provisions started on January 1st of 2018, but will expire, as Alex indicated, at the end of 2025. So in 2026, if Congress does nothing, the old provisions will be resurrected automatically, and so that just adds complexity. As Marilyn said initially, there has been an enormous amount of confusion in working with working families, because while most of the tax provisions truly did start January 1st, 2018, 2018 is the beginning of 2018 is the tax filing season for 2017 income tax returns. And so during the 2017 tax return filing season, individuals were not seeing any impact from this Tax Act. And so I think there was a lot of confusion. As you know, beginning in February of 2018, the IRS, which of course is underfunded and doesn't have enough staff were scrambling to try to change the withholding tables. And so they did finally put new withholding tables into play sometime in February. Well, I will tell you right now, they are constantly tweeting, the IRS is constantly tweeting and reminding individuals to check their withholding. So I think there is some serious concern by the government that the withholding is not necessarily going to be sufficient to perhaps generate the refunds come 2019 next year at this time. So it's very interesting because this sweeping tax reform, tax cuts were done literally in the middle of the night at the end of December. The government, again, that's underfunded before this Tax Act, the Internal Revenue Service has been scrambling to try to put this together. And so it will be very interesting to see what next tax season is like. So for those of you that are working on the front lines, you do need to work with your clients to make sure that they are properly withheld on and that they're not going to have a wake-up call next tax season with a amount due. Most interesting to me among the permanent provisions was the repeal of the shared responsibility payment. What's interesting about that is for many reasons. So the shared responsibility payment is the penalty for not having affordable health care. So why would repealing a penalty, a tax, generate an enormous amount of money to pay for these corporate tax cuts? Well, the reason I would suggest is somewhat not transparent and is terribly off-putting when you understand it. The reason why the repeal of the shared responsibility payment will generate $314 billion in saved government money is that the individuals who are not going to have affordable health care because this penalty has been repealed would have qualified for generous subsidies under the premium tax credit. So what is very confusing to individuals, while the mandate to have affordable health care has been repealed beginning next year, not for 2018, the premium tax credit, which subsidizes affordable health care, which makes health care affordable for lower income families, still exists. So we have to continue to encourage people to have affordable health care and use the premium tax credit. The only way this revenue is generated is if low-income families don't have affordable health care. That is paying for corporate tax cuts, which on its face doesn't make sense to me as a social policy advocate. In addition, as Alex has said, chained CPI is the new indexing. So what that means is slower increases for the standard deduction, slower increases, less generous increases for the earned income tax credit, and less increase for now the refundable child tax credit. And so that targets really working families. Another permanent provision which is interesting is that Section 529 plans, which are the tax-exempt plans that you can save for college. Not surprisingly, these are used by higher income families to save for college. Up to $10,000 per year can now be used for K through 12 education. This is part of the defunding of public education and allowing families, more affluent families who can afford private education to effectively be able to subsidize that with tax subsidized dollars. So as Alex has indicated, the income tax rates were decreased across the board. But what is interesting is the lowest income tax rate, which is the 10% rate, which kicks in after arguably a zero bracket rate. Zero bracket rate effectively is now the standard deduction. That 10% rate did not decrease, although we can see the rates decreased across the board. Again, that impacts the lowest income working families. That rate could readily have been decreased, and if it had been decreased, those families would have spent those tax dollars as compared to the highest income rate, marginal rate decrease. By the way, these brackets compared to the old brackets are not perfectly aligned. So there were a lot of individual income tax changes on the income tax side. Most of these don't affect lower income families, but they are kind of curious, and I think they do indicate some of the targeting. So for example, the commuter bike subsidy, which allowed your employer to pay up to less than $200 for you to get a bike so that you could bike to work and not have that included in gross income, that was repealed. And so you can see very odd targeted repealing. One provision that, because of advocates, a student and a member of Congress that really advocated for this, if student loans are canceled because of a student's death or disability, this actually was a real life case, that cancellation of debt had to be included in the gross income of the surviving spouse. That now is excluded. So advocacy does work. As Alex has indicated, we now have increased standard deduction amounts, but because of changed CPI, they won't increase as readily as they have in the past. I do think a really important thing to do is to look at the House bill as compared to the Senate bill, because the House bill was certainly more onerous with respect to lower income individuals. And perhaps that's foreshadowing of what is to come in the Republican agenda. And under the House bill, the additional amounts for being aged or blind, those amounts were repealed. Fortunately, in the Senate bill and then in the final Tax Act, those were brought back. And the reason they were brought back was because of lobbyists, including people with disabilities, and AARP opposed this, and so now we do have these additional amounts for the standard deduction for folks who are aged, which is 65 or above, and blind individuals. So again, sound bites. When they were selling this bill, they said, well, the standard deduction is double. Really isn't double. And it's even less generous than this slide indicates, because as we know, the personal dependency exemptions have been repealed for or suspended for this interim period. So some curious things, if we really wanted to stimulate the economy in a way that people could move and work wherever good jobs are. For some reason, members of Congress decided to repeal the moving expense deduction. So now even if your employer reimburses you, you have to pick that up in gross income. As we said, the standard deduction amounts were increased, but at the same time, the personal dependency exemptions, which were scheduled to be over $4,000 in 2018, those were repealed or suspended for this temporary time period. What is really interesting about this is higher income households are not suffering this suspension of the personal dependency exemptions because the personal dependency exemption was phased out for those higher income individual families anyway, and so this doesn't impact them at all. There are other deductions that folks have already talked about, but the bottom line here for most taxpayers, the vast majority of taxpayers, maybe up to 90% of all taxpayers, is that they are not going to be itemizing their deductions. In Nevada, where I have the pleasure and privilege of teaching, I would say that the percentage of individuals, because we're a no income tax state, we have low cost of housing, low interest rates, likely more than 90% will be using the standard deduction. Interesting, again, itemized deductions that were treated more favorably are the percentage of cash charitable donations was 50%. That has been increased to 60%. So of the wealthy, we're now subsidizing more of their cash contributions to their targeted charities. So in addition to the changes in the income tax exclusions and deductions, over the last several years, we've seen enhanced burdens on lower income families and immigrants. They're being targeted as compared to the higher income counterparts. So under this new Tax Act, the head of household filing status, there are new paid preparers due diligence requirements that are going to cause perhaps fewer families to be able to use the head of household filing status. By the way, at one point they were talking about eliminating the head of household filing status, which is a filing status for single parents with children who provide over half of the cost of the household. Now for refundable credits like the child tax credit and the American Opportunity Tax Credit, which subsidizes college. That's a refundable credit for first 4 years of college, up to $1,000 for lower income and middle income individuals who are in college to help subsidize the cost of college. Earned income tax credit, these credits are getting more and more scrutiny in addition to being audited at a much higher rate than higher income individuals. Now, to the extent you use one of these credits inappropriately, and I'm using quotes, the government can deny these credits for 2 years due to reckless or intentional disregard. By the way, what is that? Unfortunately, because we don't regulate paid preparers, we have a lot of unscrupulous paid preparers who will claim these credits for taxpayers who don't understand the rules because they are so complex. And then as a result, the taxpayer loses the opportunity to use these credits for 2 years if it's reckless or intentional disregard, and for 10 years if the government determines that it was due to fraud. Because so few of these lower income individuals don't have access to tax justice, these determinations could be made without their input, and then they lose the credit for an extended period of time. What is so off-putting about this is, of course, that if you lose these credits for 2 or 10 years, effectively you will never get to use them to subsidize your working family. What's interesting is you could be a murderer or worse and still claim the home mortgage interest deduction without any impact, but yet for these working families, we have these very cryptic and unusual denials of getting these benefits. In addition, the government has clearly been targeting immigrants and undocumented immigrants, as well as mixed immigration families. An ITIN, which is the taxpayer identification number that is used by individuals who cannot get a Social Security number. These numbers, because there's this concern about fraud, without very good empirical data, have to be renewed. And so while your Social Security number is a number you get at birth and you use for the rest of your life, an ITIN now has to be renewed with a very onerous requirement that you have to actually mail to the federal government your identification documents, including your passport. So you can imagine an individual who's undocumented in this political climate having to mail in their passport to the Internal Revenue Service. The good news is there is an alternative, but it's expensive. Again, an expensive requirement for individuals who are demographically lower income. So these ITINs have to be renewed, and not only do they have to be renewed, but you have to use a Social Security number or an ITIN that was issued before the due date of your tax return. And so because we have such a bottleneck in our immigration process, quite often these numbers and a government Internal Revenue Service that is underfunded and understaffed, it's often very time consuming to get these numbers. And so if you don't have this number in a timely manner, you lose tax benefits. We don't have that for any other population in our tax system. So it's targeted and it is creating burdens and expenses for the most vulnerable taxpayers. Most interestingly to me, while the personal dependency exemption has been eliminated for this certain period of time, the child tax credit has been increased to $2,000 from $1,000, but it's not fully refundable. So that means working families that do not, with children that do not have enough income to generate a tax liability to offset will not get to enjoy this. What is fascinating is we're seeing this again across the board with all sorts of social benefits, including Medicaid and food stamps, SNAP, and TANF, as Dean mentioned earlier, that all of those social benefits are being tied to earned income. And so if you look at the poverty demographics, if you fall out of the workforce, you fall into deep poverty because the safety nets for people who do not work are few and far between. More and more work requirements are making, including in our tax system. So the child tax credit is not just to subsidize children. There is a clear work requirement. In addition, again, targeting immigrants. We're seeing that you have to have, and we've been pushing back on this provision forever, in order to get the child tax credit now, the qualifying child must have a Social Security number. An ITIN will not work. That is going to cause a tax increase for many undocumented immigrant families who are paying taxes and also paying into Social Security and Medicare, which they don't benefit from. What is really frustrating to those of us that work with these families is they increase the phase-out threshold for the child tax credit. So now a family that makes $400,000, a married filing joint family, gets a sudden benefit for having children. They get $2,000 per child, whereas under the old tax provisions, they got $0. Because the child tax credit does not have a perfect overlap with the dependency exemption that has been suspended, they have this new non-qualifying child credit, which is $500, which is not refundable, and it has been increased for these phase-out thresholds as well. Now, I've got a bunch of examples here, and those of you that want to take some time to look at these examples with some detail and time, you've got my PowerPoint that you have handy as a handout. Please don't hesitate to email me with questions if you have any questions about the particular details here. Minimum wage working family, we see them in Nevada making $8 an hour, single mom with 2 kids. She gets a tax increase under this new provision of $25. That is because, and by the way, the earned income tax credit wasn't changed at all. In fact, if anything, it was decreased because of the new change CPI. Congress could have changed that very readily and made it more generous. Her child tax credit was $2,000 under the old laws. Under the new laws, it's $2,025. And so you can see that's not a very big increase. The higher income working family saves over $5,600, predominantly because of the child tax credit of $4,000 that they didn't get before. You can see if we double this to a minimum wage working family that gets over $32,000, married couple with 2 kids, their savings only goes up to $1,040. Versus the higher income working family, they get $4,000 child tax credit where they didn't have any. Their tax savings is $23,227. Now, I've got a number of other examples that it looks like we're not going to have time to go through, but I just want you to imagine Congress had a blank slate. They could have reversed these refunds. Can you imagine if that minimum wage working family got even half of the $23,000 tax savings? They would have spent it immediately. As Dean, the Economist, would acknowledge, that would have created a multiplier effect. It would have been targeted to their neighborhoods and to their communities that need this subsidy, that need this stimulation. And the higher income working family, they don't really need this additional money. It's just going into their savings, and indeed they're likely not to spend it. And so there are so many things Congress could have done that they didn't. You can see this just gets exacerbated with 3 or 4 or 5 children. Why? A 5 children, married couple with 5 kids get an additional $75. Why? Because the child tax credit, the refundable portion, is capped based upon income. And minimum wage workers don't have a living wage, living in poverty with that number of children. The higher income working family, $4,000, get $10,000 that they didn't previously have. The problem here is the child tax credit is not fully refundable. It's workfare, and it only subsidizes working families. If you fall out of work, you don't get this benefit, and we're seeing this more and more. Thank you for your time, and I am happy to answer any questions.
Thank you, Francine. Professor Lippman also serves on the Nevada Tax Commission at the appointment of Governor Sandoval, I will add, and so we really appreciate your insights into the impact on lower income people. I see one question from an audience member. What is the impact to the country since they are removing the foreign tax altogether instead of deferring it? Maybe for Dean or Alex.
Yeah, well, my expectation is that it will be primarily an opportunity for gaming. So the idea that companies actually move operations overseas because of the taxes, I think that's actually fairly limited. I know that it's common for political figures to say that, you know, people are moving jobs overseas. When it happens, it's almost always because they're saving on wages. That's a much, much bigger issue. But you do see tax gaming, and this gives more incentive for tax gaming. I should point out, by the way, isn't that hard to design systems where you don't have that gaming? There are just two quick ones. One is you base taxes on the proportion of their sales. Many states do that. So you just say, we're going to assume that if 70% of your sales are in the U.S., 70% of your profits are in the U.S., and that's the basis of your taxes. The other one is you have companies give a non-voting equity stake. I've worked on this on some other people, that you just say, okay, we're going to tax you. You know, their rate's 21%. Give us shares equal to 21% of your total shares. We don't have any vote. The government doesn't have any vote. But the idea is if you pay a $2 a share dividend to your regular shares, you give us $2 a share. If you buy back 10% of your regular shares at $100 a share, you buy back 10% of our shares at $100 a share. I don't see any way around that. It's very simple. It would actually save firms money because they don't have to go through all this rigmarole with accounting. And it means we get the taxes we're supposed to get, and you won't get anything by pretending that all your profits came from Ireland. So you can do it, but you know, I don't think that was the motivation of the Republicans and President Trump when they put this forward.
Thank you. One other question. Currently, international visitors to the United States who earn U.S. source income are not eligible to claim a standard deduction. They only get to claim a personal exemption. So if the new tax law makes the personal exemption zero, do they get to, did the law change to allow those visitors to take the standard deduction? If you know.
I don't know the answer to it myself. Perhaps Francine does, but I think this is just an example of the many issues that have arisen from this bill because it was rushed through so quickly. There wasn't adequate time for practitioners to take a look at it and figure out what the questions were so they could be resolved legislatively. And there will be many years, I'm sure, of guidance and efforts to answer these questions. Meanwhile, I'm not quite sure what people are supposed to do, but some of these questions can't even be answered by Treasury because they don't technically have authority. They're really not supposed to be legislating. So they're just supposed to give guidance on what was enacted. But yeah.
Just by contrast, just to emphasize that point, if you go back to the '86 tax reform, which was often held up as the precedent, the model, that was totally bipartisan. That was debated back and forth, and you had the committees of Congress working on this, and you did have the tax experts weighing in. Inevitably, whatever you pass, there's going to be something someone missed. But when you do it the way they did this, where it was rushed and they're writing at the last minute, I mean, sure, many people saw that you had provisions of the Tax Act that were literally hand scribbled, you know, and that's not the way to do a major tax reform.
It was exactly 7 weeks from when it was first introduced with actual language to when it was signed by the president. 7 weeks.
As recently as the end of March, I don't believe the IRS had adopted any rules, regulations interpreting these provisions. Is that still true? You know?
My understanding, we have nothing to date. You know, again, They are underfunded, understaffed, and trying to literally race to the finish with updating publications and dealing with 2017. As we know, their website crashed on April 17th, 2018 because of so much input, and just they're literally scrambling to deal with historical issues, let alone this sweeping reform.
I should mention one other thing with the IRS that would be getting more attention if this administration didn't have so many other scandals. We don't have a director of the IRS. We have an acting director, and that matters for two reasons. One is that an acting director doesn't go to the Senate for scrutiny, so is the person qualified? Do they have conflicts of interest? That's not asked of an acting director. But the other and probably more important thing is IRS director is someone who could only be dismissed for cause. He or she's not a cabinet member. They're not like the Secretary of State that the president can get rid of anytime they're unhappy with them. The director of the IRS is only supposed to be dismissed for a cause. An acting director can be dismissed any day of the week for any reason. That's a big problem in my view. I mean, suppose Donald Trump says his taxes are being audited. Who knows whether that's true or not, but suppose he doesn't like the way the IRS is auditing it. He could dump the IRS director because he's demanding that Donald Trump pays his taxes. That's not supposed to happen, and that's a real problem.
All right. Well, thank you, all of the panelists and the audience, for participating by listening in, and we hope that you'll tell anyone else who's interested that they can find the materials on the website for the Civil Rights Social Justice section. We'll conclude at this time.
Thank you.
Thanks.